There is a tax system that some of the wealthiest people in America use instead of the income tax you and I pay every year. It's not a write-off, it's not an offshore account, it's not illegal. It's a completely different way of getting money out of your assets. And it's the reason certain billionaires can report a taxable income of basically zero while their net worth grows by billions. I'm going to show you exactly how it works, step by step, using the same numbers a real financial advisor would use. And at the end, I'll show you where this strategy actually breaks down, because it's not the magic trick some corners of the internet make it sound like. Let's get into it. Okay, first, let's be precise. Because precision is what separates a real financial education channel from a conspiracy channel. This strategy has a real name. Financial planners and tax attorneys call it buy, borrow, die. It didn't replace the income tax code. The income tax still exists, and everyone, including billionaires, still has to file a return. What this strategy does is much narrower and much more clever. It lets someone avoid ever triggering a taxable event in the first place. Here's the one-sentence version. The IRS taxes income when it's realized, meaning when you sell something or get paid. If you never sell, and you never get paid a salary, there's very little for the IRS to tax. So instead of selling assets to fund their lifestyle, wealthy households borrow against them. That's the whole idea. Everything else in this video is just the mechanics of how that plays out, and the very real risks that come with it, which almost nobody making viral content about this ever shows you. Let's break this into the 3 moves. Move 1. Buy. Step 1 is simple. You buy appreciating assets. Stock, real estate, a stake in a business. The wealth doesn't come from a paycheck, it comes from ownership. Here's why that matters. Unrealized gains are not taxable income. If your Amazon stock goes from $10 million to $40 million, you don't owe the IRS a cent on that $30 million as long as you never sell it. Compare that to a salary. If you earn $30 million in wages, you owe ordinary income tax on it immediately, up to the top federal bracket. Same $30 million. Completely different tax outcome, purely based on whether it came from selling your labor or from an asset simply growing in value. Move 2. Borrow. Step 2 is where it gets interesting. Instead of selling stock to pay for a house, a boat, or just living expenses, which would trigger capital gains tax, you borrow against the stock instead. Brokerages offer this through securities-based lines of credit, and banks offer portfolio-backed loans. You pledge your shares as collateral, and the bank hands you cash, often at loan-to-value ratios in the 50 to 70% range for a diversified portfolio. And here's the part that makes this whole system work. Loan proceeds are not income. You didn't sell anything, you didn't earn anything, you took on debt. The IRS has never taxed borrowed money because legally it's not yours. You owe it back. So you get spendable cash with zero capital gains tax and zero income tax owed on it. You pay interest on the loan, sure, but for a well-collateralized loan against a large portfolio, that interest rate is very often lower than the capital gains tax rate you'd have paid to get the same cash by selling. Move 3. Die. Step 3 is the one that finishes the loop, and it's the part most people have never heard of, the step up in basis. When you die, the assets in your estate reset their cost basis to their current market value. Under current law, if your heirs inherit stock that you originally bought for $2 million and it's worth $40 million when you pass away, their new cost basis is $40 million, not $2 million. If your parent bought stock for $50,000 decades ago and it was worth $500,000 when they died, your basis becomes $500,000. Sell it the next day for $500,000 and you owe zero capital gains tax. So the $30 million of gains that grew over that person's lifetime, it's never taxed. Not while they're alive, because they never sold. And not after they die, because the basis reset erased it. Then the estate simply pays off the outstanding loan balance using estate assets or a portion of the now stepped-up portfolio, and whatever's left passes to the heirs. Now let's talk about how this actually gets constructed in real life, because it's not just borrow against your 401k. This only works with a very specific setup. Step 1. Concentrate wealth in appreciating, liquid, low-basis assets. Public company stock, especially founder or executive shares, is the classic example. Real estate works too, but it's less liquid, so lenders are pickier. Step 2. Open a securities-based line of credit, not a margin account for trading. These are structured differently from a trading margin loan. They're typically used purely for spending, buying property, funding a business, paying for lifestyle, not for buying more securities, which keeps the loan-to-value ratio safer and the terms more favorable. Step 3. Draw only what keeps you well under the loan-to-value ceiling. Advisors typically aim to keep total borrowing well below the maximum the bank would allow, often in the 20–30% range of the portfolio's value, even when the bank would technically extend more, specifically so a market downturn doesn't trigger a margin call. Step 4. For larger estates, layer in trusts. Grantor trusts, GRATs, and irrevocable trusts can move future appreciation out of the taxable estate entirely, which stacks with the buy, borrow, die loop rather than replacing it. This is a separate, more complex layer. It's why estate attorneys, not just financial advisors, get involved once a portfolio reaches 8 or 9 figures. Step 5. Plan the estate transfer around the exemption and the step-up. As of the One Big Beautiful Bill Act, signed July 4, 2025, the federal estate tax exemption rose to $15 million per individual, or $30 million per married couple, effective January 1, 2026, and the law did not change the step-up in basis rule at all. So a married couple can pass up to $30 million completely free of federal estate tax, on top of the capital gains that get erased by the basis reset. Anything above that exemption is taxed. Estates exceeding the threshold are taxed at a top rate of 40%, which is exactly why the trust layer matters so much for the ultra-wealthy. Just to put numbers side by side, selling $10 million of stock at the top bracket costs roughly $238 million in federal capital gains tax plus the net investment income tax. Borrowing $10 million against that same stock costs $0 in tax, just the loan interest. Now, here's the part that gets left out of almost every viral short about this, and it's important because I don't want you walking away thinking this is a free lunch. First, this only works with debt you can actually service. Loans against a portfolio still charge interest, and unlike a mortgage, that interest usually isn't tax deductible unless the borrowed funds go toward producing investment income. If interest rates rise, the carrying cost of this strategy rises with it. Second, margin and collateral calls are real. If your collateral drops in value, say the stock market falls 30%, the lender can require you to post more collateral or pay down the loan immediately, often forcing a sale at the worst possible time. This is the single biggest risk of the whole strategy, and it's the reason advisors keep loan-to-value ratios conservative. Third, this requires a very specific starting point. You need large, appreciating, liquid, low-basis assets to begin with. It does essentially nothing for someone whose wealth is mostly W-2 income, because there's no asset to borrow against and no gain to defer in the first place. This is a strategy for asset-rich households, not a general tax hack anyone can copy. Fourth, the loan doesn't vanish. It gets paid down by the estate. Die isn't really the end of the story tax-wise. The estate still has to settle the loan balance, usually by selling some of the now stepped-up assets or through life insurance set aside for exactly that purpose. So there is a real cost. It's just paid in interest and estate planning fees rather than capital gains tax. And fifth, the politics of this aren't settled. Proposals to tax unrealized gains for ultra-high net worth households have been introduced in Washington multiple times in recent years and have not become law. That could change in the future, and if it does, this exact playbook would need to be rebuilt. I'll leave political opinions about whether it should change out of this video. That's for you to decide. But it's worth knowing the ground isn't guaranteed to stay fixed. So, to bring it all together, the wealthy aren't avoiding taxes through some secret system hidden from the rest of us. They're using 3 legal, well-documented tools most people have just never had explained to them clearly. Not realizing gains until they have to, borrowing against assets instead of selling them, and letting the step up in basis reset the clock at death. You don't need $40 million for this information to be useful. Understanding why borrowed money isn't taxed, and why unrealized gains aren't taxed, changes how you think about your own investing, even at a much smaller scale. Frequently asked questions. Q. What is the buy, borrow, die tax strategy? A. Buy, borrow, die is a legal strategy where a person buys appreciating assets, borrows against them instead of selling to fund spending, and lets those assets pass to heirs at death with a stepped-up cost basis, avoiding capital gains tax at every stage. Q. Why don't billionaires pay income tax on their net worth growth? A. Because unrealized gains, and assets increase in value before it's sold, are not considered taxable income under U.S. tax law. Tax is only owed when a gain is realized, meaning the asset is actually sold. Q. Is borrowing against stock taxable? A. No. Loan proceeds are not income because the money must be repaid. Borrowing against a stock portfolio through a securities-based line of credit does not trigger capital gains tax or income tax. Q. What is the step-up in basis? A. The step-up in basis is a rule under 26 U.S. Code, paragraph 14, that resets an inherited asset's cost basis to its fair market value at the date of the original owner's death, erasing any capital gains that accrued during their lifetime. Q. Is the buy, borrow, die strategy legal? A. Yes. It relies entirely on existing, well-established tax rules. The realization requirement, standard securities-backed lending, and the step-up in basis, rather than any loophole or illegal structure. Q. What is the federal estate tax exemption in 2026? A. As of 2026, the federal estate tax exemption is $15 million per individual and $30 million per married couple, following the One Big Beautiful Bill Act signed July 4, 2025. Q. What are the risks of the buy, borrow, die strategy? A. The main risks are margin or collateral calls if asset values drop, rising interest costs on the loan, illiquidity, and the fact that it only works for households with large, appreciating, low-basis assets. If this was valuable to you, share it with someone who needs to hear it. Financial education is one of the most important gifts you can pass on. Like and subscribe. I'll see you in the next one. Thanks for watching.